Hey everybody, I'm Don Fishback and welcome back, Terry. We're here for another edition of What the Hell is Going On? It's been another crazy week in the market.
It has.
And I'm going to go over some of that stuff with everybody. But you have some questions you wanted to follow up from one of the videos you and I did a couple of weeks ago. 3 weeks ago, right?
3 weeks ago.
All right.
Time flies, right?
All right. Well, fire away.
Big question. Last time I asked you about what you thought was the best thing to do, and you said...
Yeah, I've got some things. Yeah, exactly. So where do I see the most opportunity in the market? And to me, the biggest opportunity was in the buying of calls. So if you think about this, folks, what we were looking for is we were looking for the best bang for the buck. And if you had gone into a sector like airlines or technology or energy or whatever, there really wasn't a good opportunity. It's not that there was bad opportunity, although the coronavirus has changed that. But the big thing was the options were really cheap. The calls were really cheap. And so instead of spending all that money on the stocks, you could instead buy inexpensive calls. In fact, research that we've done has shown that you could have taken about 4% of your portfolio, invested it in calls, and left the other 96 in cash, and gotten the same bang for your buck with the calls as you would have gotten had you put 100% in stocks. Well, now you think about it. I mean, we're seeing the market down 4% in a day, and it's down 13%, I think, since we shot that video. So using the calls as a replacement for stock when the price is right, and that's the key, the price is not right now to be buying calls, but when the price is right, you can actually get better risk for your money with the same reward potential. So getting better risk, same reward, that's a whole good, that's really good. So that's why I like calls. Right now I've got a little bit of a different idea, and we're going to go over that in a second. But Terry, you have another question for me.
I do. Okay. I asked you about what's the one indicator that you're following right now?
You did ask me that.
Yes,
and it stays the same. The big indicator that I'm following remains the same. It's commodities. I mean, the gang here in the office, they hear me talking about commodities over and over and over again. And the reason I'm looking at commodities is because it's a sign of demand. So I've talked about this in other videos, but commodities are a huge sign of demand. I just saw an article just a few moments ago about the shipping volume, the container volume in the Chinese ports. And what you're seeing is that they're down 80%. They're only 20% of what they were just previously. So when you have that gigantic compression in container volume, it's a sign that their factories are slow. It's a sign that demand for shipping everything is slow. So the fuel for the ships is slow. When they get here to the US, the trucks that take everything out to the stores, that's going to slow down. So you're not going to have the trucking. It just everything's slowing down. You're seeing the same thing with the airlines. They're parking the airplanes. So the demand for fuel goes like this, and that is a sign that just tells us that the economy is slowing. So that's the big thing, is the commodities. Now, what is that going to cause? And the concern that we have is the spillover to deflation. And I'm going to bring up a chart here real quick. There we go. This is a chart of our deflation indicator, and it's going back to 1991. And what we're looking for, here it is right now, and this is as of this morning. It's right here, the deflation indicator is right there. And what our concern is that when it gets really low, it's a sign that the economy is slowing, and slowing so much that it creates what we call hoarding. So that's a problem, and I'm going to explain that in just a second. So we're looking for signs of extreme deflation. It's bad right now, but it's not catastrophically bad. This is catastrophically bad. This is 2008 right here when the economy was just falling off a cliff. So the economy's slowing down rapidly, but it's not catastrophically bad yet. Where you run into the problem is when you get into something that's called hoarding, Hoardin, G. And if you think about, you might have seen stuff on TV where they talk about people hoarding and things like that. It's kind of the similar thing. And you're actually seeing it in the markets right now. What's happening right now in the stock market and the bond market is hoarding. People are hoarding cash. So they're selling their stocks and they're buying bonds. So you got the money, the outflows going that way with the stocks, and the money's going into bonds. So they're hoarding cash. That's not a good thing, but it's not catastrophically bad. What is bad is when you get one of these things, is when you get into one of these spirals. This is where you get what's called a deflationary spiral. And a deflationary spiral is where it goes from just hoarding cash, like consumers and stock investors, is where it gets into consumers really pull back hard on their spending, like they did after 9/11. I mean, you had the travel industry just collapse at that point, or the businesses say, you know what, we've got to hoard cash. And that's when things really become problematic, because how do businesses hoard cash? They let people go. And then you get that spillover effect. So what we're looking for in this extreme deflation, which it's bad, but it's not catastrophically bad, what we're looking for is when the airlines is a perfect example, where air travel stops, and so the airlines say, you know what, we don't need all those planes that we have on order with Boeing, we're not going to buy anymore. So they cancel orders. Well, what does that do? That causes Boeing says, well, you know what, we'll lay off some people. But it doesn't stop there. It goes to the people at the aluminum maker, right? It's places like Alcoa. And General Electric, if you look today, GE stock is down pretty hard, and it's down. I actually own some GE stock, bought it at a really good price, so I'm still ahead, but not as ahead as I was just a week ago. But GE shares are down because they make the aircraft engines. So and now you worry, is Alcoa going to have to let people off? Are GE going to be letting people off? So that's the problem. And then you see that in the news, and then consumers saying, oh my gosh, everybody's getting let go. I better stop spending in case I get let go. And then the whole cycle starts all over again. So that's why I'm so worried about extreme deflation, and that's why it's so pernicious when you get something like that. So when you get one of these extreme deflationary events, one of the common things that you get is volatility. And so I want to go back to that chart right here. So this is the Dow Jones Industrial Average. And I don't know if you can see this right, but this is 1901. 1901, not 2001, but 1901. So we're going back over a century in time. And what we've got here is, I mean, the size of the moves have been so gigantic here lately. I wanted to see if there's any kind of historical perspective where it's happened before. So I wanted to see 9 trading sessions. If there been any instance in the last 120 years, so think about that, 120 years. Has there been any instance in the last 120 years where you've had 9 trading sessions and 7 of them were where the move was up or down more than 2.9%. So big down, big up, big down, big up, or big, big, big down and big, big, big up, anything like that. So here we have them. They're marked here. So here we are right now. And then this is October 2008. And this is October 1987. And then we have 1929, and we have 1931, and 1932. So so the crash of 87, the financial crisis, and the Great Depression, and now. So what I wanted to do is I've got some statistics here that I'm going to read to you here because it's kind of important. So here are my glasses. There are my glasses. All right. So we have these 6 years, 29, 31, 32, 87, 2002, and 2008. What I wanted to find, because remember, we trade options around here. That's what we do. And these prices were so high. And let me see if I have a chart Yeah. This is a chart of the volatility index right here. And today, so this is the volatility explosion in 2018, right there, when VIX got above 50. And then right here is when China devalued their currency and it got up to 55. And then this is the 2008. And then we have September 11th and Enron. And this is when long-term capital management blew up. And 97, what was the 97? Was that Niederhofer? I think that was when Niederhofer blew up his portfolio and caused a big problem right there. So I remember these events like they were yesterday. So here we are now. Here we are right now. So you have these options that are just outrageously expensive. And so what I wanted to do was, when you see something, buy low, sell high, well, if it's the high, I want to sell high. So I wanted to see about selling some options. And I wanted to do it through a credit spread where I can reduce my margin instead of just selling a put. Through a spread, I reduce my margin and I control my risk. So let's go back to that other chart. And there we go. So you get this cluster of big moves right here in 1929. What was the maximum move down? How bad was bad? How bad was bad? The maximum move down and we're trading weeklies here. The maximum move down over the next week, 6 trading days, was minus 14.4%. Right here in 31, it was minus 14.3%. So that's as far as it fell in 1931. In 1932, as far as it fell was minus 8.9%. In 1987, after you got one of these signals, after you got one of these things right here, the maximum move down was minus 9.5%. In 2002, we don't have the mark right there. In 2002, the big move down was minus 4.7%. And right here in 2008, the big move, the worst it got, the absolute worst it got was minus 14.5%. So out of all those, the worst was minus 14.5%. So I said, is it going to get worse than the Great Depression? Is it going to get worse than 2008? Now you think about 2008. GM, if they weren't bailed out, they wouldn't be here. Bank of America weren't bailed out, they wouldn't be here. If it wasn't for a bailout, Chrysler would be gone. Now think about the companies that are gone. Bear Stearns, Lehman, well, a lot of them got taken over. AIG, that thing's gone, right? All these companies, Fannie Mae, I mean, the company that supplies the capital for almost the entire U.S. housing market, if they didn't have a bailout, they'd be gone. Is it really that bad today? And is it going to get that bad over the next 6 trading days? Is it going to get worse than that? Is it going to get worse than the Great Depression? It might. That's why I'm using a limited risk trade, but I don't know that it's going to get that bad. So I'm willing to take a bet that you can do something else. So what I did was I looked at the SPY and I said, all right, The worst one was 14.5% down. I'm going to sell a put that is more than 14.5% below the stock, the SPY value. And that was strike price of 258. So now I'm short the 258, and I did get filled on this, but I bought the 255. That was the furthest strike out of the money for next Friday's, it was Friday the 13th, by the way, the 255 strike. So, and by the way, Friday the 13th is really lucky day for me. So anyway, so that's pretty much it. We did use, I think I showed this in a previous video, we used odds online to come up with the values and stress test it. And I stress tested it, and I chose January 1st, 2008 to April 30th, 2009. I mean, the market got slaughtered during that. I mean, that's when all those companies, Countrywide's gone. All those companies just disappeared. And so I used that period. And believe it or not, the options this morning were priced above that level. And I just said, okay, so people are expecting total catastrophe over the next 6 trading days. So I want to leave you with one final thought, because what's interesting is about these particular events in 2000, all of these events, is that they weren't just market events. They were actually transformational events. So if you think about what happened right here, in this period right here, right after this period, we got the Securities and Exchange Commission. We got the FDIC. There was no FDIC prior to that. We got the New Deal, where they were trying to implement stimulus to put people back to work. We're already hearing talk from Larry Kudlow this morning about possible stimulus to help the airline industry. After this one, they realized, oh my gosh, we need to have the same circuit breaker mechanism that they have in futures and in other stock markets. We better get one of those things on the U.S. stock market. So this led to the introduction of circuit breakers on the stock market. In 2001, well, you remember that. I think you might remember that, depending on your age. But we got an entirely new cabinet level part of the government, the Department of Homeland Security, and we ended up spending about $2 trillion in Afghanistan after that. So that was truly, I mean, you go to the airport now, and it's completely different than it was on September 17th, 2001 versus September 10th, 2001. So truly transformational. And then right here in 2008, we got Dodd-Frank, and banks started treating they used to have the things called liar loans, right? The no documentation loans. That doesn't occur that much anymore. So anyway, you've got these transformational events, and we'll probably get something here. We will probably get something here, and I hope you hear that loud siren going by. So we'll probably get something transformational right here. And the way we work, the way we commute to work, the way we interact, there may be more remote working. And so think about what that might do to various businesses and the way we work to prevent and treat potential viral outbreaks. You're going to see a lot of money, a lot. There's going to be an unbelievable amount of money that's going to go into that line of work. I mean, DARPA's already spending a ton right now. Congress just allocated $8.5 billion, I think, yesterday, and Trump signed it yesterday. So anyway, there's going to be changes, and we'll get through this. So I don't want anybody to think, oh my gosh, the world is going to end. It's entirely possible, but I think it's remote. The big thing that I want you to keep an eye on, I'm going to go back to this chart, is right here, this extreme deflation. The big thing that I'm going to be watching crude oil more than anything else. Crude oil is at $42 this morning. I'm going to be watching to make sure it doesn't go below 40. If it does go below 40, something's probably broken in the economy, and that's bad, but it's not catastrophic. If it gets below 30, then something's badly broken, then we've got issues. But we're not there yet, so just be optimistic but realistic. Anyway, I want to thank you. Terry, thank you for joining me.
You're
It's
so
okay.
welcome.
Yeah,
You're so
come
welcome. You're so welcome.
on. All right. And folks, if you like the video, let us know. It's the only way we know whether we're doing something that you want us to continue. Just give us some comments, subscribe. Visit our website, www.donfishback.com. And you all hang in there. All right? Bye now.